Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the International Corporate Accounting Questions and Answers 1 of 2. Hope you will like, share and special request to all to don't forget to subscribe our channel. Book value and operational risk. Book value. Book value is the value of a company's assets as reported on the balance sheet, calculated as total assets minus liabilities. Operational risk. Operational risk refers to the potential loss resulting from inadequate or failed internal processes, people, systems, or external events. Example: reputational damage, safety hazards, IT infrastructure damage, loss of customers or employees, etc. Inflation. Inflation is the rate at which the general price levels of the goods and services arises, eroding purchasing power over time. Rights issue and capital allocation. Rights issue. Rights issue is an offer by a company to existing shareholders to purchase additional shares at a discounted price, typically to raise capital. For example, the stock that you bought recently has declared a 1:5 rights issue. This means that you have the option to buy one new share for every 5 shares you own. Capital allocation. Capital allocation is the process of deciding how to distribute financial resources across various investment opportunities to maximize returns. For example, allocating funds to expand into an emerging market by setting up new offices and hiring new or local talent. Portfolio diversification. Portfolio diversification is the practice of spreading investments across various asset classes or sectors to reduce risk. For example, if you have a portfolio of only large cap stocks, you can diversify it by adding some mid cap and small cap stocks, which may offer high growth potential but also higher unpredictability. Forward contracts and future contracts. Forward contracts and future contracts. A few forward contract is a customized agreement between two parties to buy or sell an asset at a specific price in the future, while a future contract is standardized and traded on exchanges. For examples for forward contracts and future contracts. Example for forward contracts. If a forward contract fixes a price of 75 US dollars for Microsoft stock and at settlement the stock is worth 85 US dollars, the buyer gains US dollars 10 per share. Example for future contracts. A farmer may use to lock in a price for the crop to protect against price declines, while an investor might speculate on rising prices to earn a profit. Zero coupon bond. A zero coupon bond does not pay periodic interest. Instead, it is issued at a discount and redeemed at face value upon maturity. For example, you might pay 3,500 US dollars to purchase a 20-year zero coupon bond with a face value of 10,000 US dollars. After 20 years, the issuer of the bond pays you 10,000 US dollars. For this reason, zero coupon bonds are often or most often purchased to meet future expenses such as college costs or an anticipated expenditure in retirement. Altman Z-score. Altman Z-score formula was derived by Edward I. Altman in 1968, is a formula that predicts the likelihood of a company going bankruptcy based on its financial ratios and performance metrics. The Altman uh, the Altman Z-score formula is 1.2 multiplied by A in brackets plus 1.4 multiplied by B in bracket plus 3.3 multiplied by C in bracket plus 0.6 by D in brackets plus 0.999 multiplied by E in brackets. Here, A is working capital divided by total assets, B is retained earnings divided by total assets, C is earnings before interest and tax payment divided by total assets, D is equity market value divided by total assets, and E is total sales by total assets. The value of Altman Z-score is typically around -0.25 for businesses with the highest bankruptcy risk. Conversely, the Altman Z-score value might reach +4.48 for businesses with the lowest likelihood of insolvency. Earnings call. An earnings call is a conference call in which a company discusses its financial results with investors, analysts, and the media. They are usually hosted after the publication of earnings reports. P/E ratio. The P/E ratio, or simply profits to earnings ratio, is measures a company's current share price relative to its per share earnings, used to gauge market expectations of future earnings growth. Primary market and IRR. Primary market. The primary market is where new securities are issued and sold to investors directly, often through initial public offerings, that is IPOs. Here example is initial public offering or IPO. IRR, internal rate of return, or simply IRR, is a financial metric used to measure the profitability of an investment that takes into account the time value of money. In simple words, IRR is the discount rate that makes the net present value, that's NPV, of all cash flows from an investment equals to zero. ROE and junk bond. ROE, return on equity, or simply ROE, measures a company's profitability by showing how much profit it generates with the money shareholders have invested, calculated as net income divided by shareholders' equity. Example: assume a company, Techco, has maintained a steady ROE of 18% over the past few years compared to the average of its peers which was 15%. An investor could conclude that tech cost management is above average at using the company's assets to create profits, and this instills the confidence in the investors. Junk bond. A junk bond is a high-yield, high-risk security issued by companies with lower credit ratings. Example of a junk bond. A good example of a junk bond company is Netflix. Convertible bond. As the name suggests, a convertible bond is a bond that can be converted into a specified number of shares of the issuing company's stock. Dividend payout ratio. The dividend payout ratio measures the proportion of earnings a company pays out to shareholders in the form of dividends, calculated as dividends per share divided by earnings per share. For example, if a company has an if a company A has a net income of 100,000 US dollars and pays out $10,000 in dividends, it would have a dividend payout ratio of 10%. That's 10,000 divided by 100,000 is equal to 10%. Systematic and unsystematic risk and leveraged loan. Systematic risk. Systematic risk is the inherent risk that affects the entire market or a large segment of the market, such as interest rate changes by the government or recessions. Unsystematic risk. Unsystematic risk is the risk that is unique to a specific company or industry, such as changes from or of management changes, or regulatory impacts such as poor manager might pose a specific risk to a single company's stock price. Leveraged loan. A loan extended to companies or individuals with high levels of debt, that is loans, usually at a higher interest rates due to increased risk. Operating leverage and interest rate swap. Operating leverage. Operating leverage refers to the extent to which a company uses fixed costs in its operations, which can enlarge profits as sales increase. Example: Company A sells 500,000 products for a unit price of $6 each. The company fixed costs are 800,000 US dollars. It costs $0.05 US dollars in variable costs per unit to make each product. A 10% revenue increase should result in a 13.5% increase in operating income. That's 10% multiplied by 1.37. Interest rate swap is a financial derivative where two parties exchange interest rate payments, typically switching between fixed and floating rates. Credit rating and venture capital. Credit rating. A credit rating assesses the creditworthiness of a borrower indicating the risk level of default for bonds or loans. This helps banks and other financial institutions to assess creditworthiness of the borrower before disbursement of any loans. Venture capital. Venture capital is a capital or funding provided by investors to startups or small businesses with long-term growth potential in exchange for equity, of course, after checking credit rating as described above. Securitization, financial distress, and economic moat. Securitization is Securit- Securitization is the process of pooling various types of debt like mortgages and selling them as securities to investors as security for their loans. Financial distress. Financial distress occurs when a company cannot meet or has difficulty paying off its financial obligations, which may lead to bankruptcy. Economic moat. An economic moat refers to a company's competitive advantage that allows it to protect its market share and profitability from competitors. Example for economic moat. In short, moats protect the market share and positioning of companies and facilitate the long-term sustainability of their business model, including the continued generation of profitability. For instance, brand identity and reputation encourage customer loyalty, as seen in the case of Coca-Cola. Arbitrage. Arbitrage involves profiting from price differences of identical or similar financial instruments on different markets or in different forms. For example, a commodity might be cheaper in some countries than the other countries. Credit default swap. Credit default swap, or simply CDS, is a financial derivative again that allows an investor to swap or offset credit risk with another party. Example: the bank may enter CDS, that is credit default swap contract with an institutional investor. In this contract, the bank agrees to pay the institutional investor a quality premium. In return, the institutional investor guarantees to the bank that if any of the bank's borrowers default, the investor will pay the defaulted amount to the bank. Corporate governance, cost of equity, and alpha in investing. Corporate governance. Corporate governance refers to the system of rules, practices, and processes by which a company is directed and controlled. Cost of equity. The cost of equity is the return that equity investors expect to receive from an investment in a company, often estimated using CAPM. CAPM we will discuss in the next video. Alpha in investing. Alpha is a measure of an investment's performance relative to a benchmark, representing the excess return achieved when compared with their own benchmark. Example, let's say that the expected return is 12% after a year. The risk-free rate of return is 10%. The beta is 1.2 and the benchmark is 11%. Your alpha calculation would then be 12 minus 10 minus 1.2 multiplied by 11 minus 10 in the brackets. This means that the alpha is 0.8%. Modigliani-Miller theorem. The Modigliani-Miller theorem states that in a perfect market, the value of a firm is unaffected by how it is financed, whether through debt or equity. Important thing is that the enterprise or the firm is getting finances. Example of Modigliani and Miller and the levered firm the levered firm experiences an increase in the cost of equity from 7.4% to 8.25% with taxes. When the debt-to-equity ratio rises from 50/50 to 60/40, equity multiplier. The equity multiplier measures a company's financial leverage by dividing total assets by total equity, indicating the proportion of a company's assets financed by shareholders. Example: suppose company ABC has total assets of 10 million US dollars and stockholders' equity of 2 million US dollars. Its equity multiplier is 5, that's 10 million US dollars divided by 2 million US dollars. This means Company ABC uses equity to finance 20% of its assets and 80% by debt. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe to our channel. Accounts and Finance with FARSK. Thank you. Have a great day.